Thank you very much, Ashley. Much appreciated, and welcome everyone this morning. As Ashley said, my name is Ricardo Noguera, and I'm with the State Department working on climate finance matters. And today we're lucky that we're going to be able to go into greater detail and look at two really interesting approaches in terms of catalyzing finance. And just to give it a little bit of kind of a perspective from the State Department, one of the big things we're working on, and everyone at this COP is paying attention to, is how do we help finance a paradigm shift of growth for developing countries? How do we make sure that the developing countries are growing in a way that's cleaner and more resilient and more climate friendly? And that's going to take money. And it cannot simply be done with public funds. That is not an option. So you really have to think about how do you best use public funds so you can mobilize other sources of financing. And that takes a little bit of trial and error to kind of figure out the best tools in what are sometimes complicated markets. So today we're going to address two tools that we funded at the State Department and that we're very proud of. So I'm going to hand it off to Vikram Wij, and as Ashley said, Vikram's with the World Bank, where he leads the climate team, and World Bank also includes the IFC, which Vikram, some people might know Vikram more as an IFC guy, but it's all part of one big group. Go ahead, Vikram.
Thank you, Rick, and thank you, Ashley, and thank you to the U.S. Center for hosting us. No, I'm not the head of climate. I'm just the head of climate finance and climate and carbon finance. So let me not usurp my boss or my boss's title here, but thank you anyway. Yes, thanks for that upgrade. We'll take that. Look, and thank you all for being here. It's Saturday morning, and we are outside Paris. So to be here actually in Le Bourget is quite nice that you guys are here. I'll leave it at that. I'll use a few slides. Actually, it was the next slide that an infographic I wanted to share, which is why we decided to use slides, but I thought it'll be just more convenient to sort of talk through some of this stuff. Let me not go there yet. Just to give you some background on the pilot auction facility, full name, Pilot Auction Facility for Methane and Climate Mitigation. Now, this was an innovative model that we have sort of, we launched the design of nearly 2 years ago, and it was put in place and started to be implemented after it was funded late last year. And the idea was, how do you continue to sort of provide value, by using public funding in the most efficient way possible to projects that are generating greenhouse gas emissions, especially methane, which is very potent, and the science. And some of you who were there at the LPA SLCP Action Day yesterday, wow, those were too many acronyms there. But the short-lived climate pollutants, science and the scientists are telling us, are a critical sort of, if you will, a hedge till we actually get our act together on mitigating CO2 per se. And if we can address gases like methane, then we buy ourselves some time in order to sort of bend that emissions trajectory. So why are we here at the US Center? Well, because the US, along with Germany, Sweden, and Switzerland, are the funders of this initiative. And the whole initiative actually came out of a report, an expert group that was convened under the G8 and taken up by the CCAC, the Climate and Clean Air Coalition. And I see Yevgen's in the audience here. She represents that group as well, and she's an observer on all our activities. So what is this? What is the thing? So let me, this pilot auction facility really is a approach. It came out of discussions with some of the US economists as well as the US people at the US state at that time. And the idea was, how could we use not necessarily bilateral purchase agreements, which were prevalent in the carbon market, but provide some sort of a risk management instrument to the projects so that they had a guaranteed price they could put in their business models. But if the market became better over time, by the time these credits had to be delivered, they could simply go off and sell these into the market. Now, we all know that market doesn't really exist right now, it's not about to happen, but it was a good way of testing it. And for those of you who are in the financial markets would recognize that what I described just now was really a put option, where you effectively write a put option to these projects for a certain price of carbon credits, and if they choose to exercise it, you pay for it. And if you don't, if they choose to sell it to somebody else, fine. The put expires and you've accomplished with very little money from public finance to actually promote the action you need. And the reason I keep repeating that is because when we get to the lessons learned part, there is huge opportunity for replication, but I get ahead of myself. So the other part was we decided to use an auction. So you can provide a put, but how do you discover what is the value this put should be? How do you most efficiently get to that strike price, as the technical lingo would say, for this put option? Do we offer $5? Do we offer $8? Do we offer $1? That knowledge actually could be obtained by scanning all the projects and whatever they're doing, but the information actually resides within those projects themselves because they know best what the economics of their operation are. Why are these methane landfill projects shutting themselves off because there is no real carbon market? What is the minimum price it would take for them to continue operating? So we used an auction. We decided we'll discover this price by actually creating an auction platform so that this information could actually be harnessed, and we would end up with hopefully the lowest strike price for this option to be issued at. So that's exactly what happened. And then the third part was, which was, how do you actually get this option implemented? These are projects. These are not for sophisticated banks with trading desks. These are not, for those of you, again, in the financial world, you've heard of ISDA, which is the Derivatives Association, whose forms are the ones that banks use with each other to actually trade derivatives, and a put option is a derivative. Now, we were not having these landfill projects in Brazil and Thailand and India and elsewhere start getting into this whole thing. So how do you get around that? And for that, we decided to go back to an infrastructure that everybody's familiar with and was already existing, was the World Bank's platform to issue bonds. And effectively, what we ended up doing was issuing a zero coupon bond so that this bond, and we can get into the details, but effectively the bond is issued for the premium these puts are sold at. They get exercised like any bond. They can be traded like any bond. And now what you have is a very liquid, tradable World Bank bond that actually embodies the put option associated with it. We can get a little bit more detail into that if somebody's interested. But just now to give you a snapshot of so this was really the infographic I wanted to share. We conducted the first auction in July of this year, and this was the outcome. And what was very interesting was that we started at so we used a reverse auction focused only on methane from waste management, and all the associated sectors there. And we started with $8 as the auction, the start price of the auction. And obviously, we got a lot of bids. I mean, anybody would know who's following the carbon market, $8 is quite a rich offer. So we got an offer to 22 million credits to be sold to us. I forgot to mention that it's a $100 million facility currently capitalized at 53 million. So we said, okay, we must do at least 2 auctions. So we put aside $25 million for this auction. Remember, this is not to save the carbon market or to save a sector. This is intended to actually pilot and test an innovative product. So we had put aside $25 million. Well, 8 times 22 million is a lot of money, much more than 25 million. So we started dropping the price of what was being offered. And that's where the reverse auction comes in. Every 15 to 30 minutes, the price went down according to a sequence. And we ended up, after 11 rounds of auctioning, with a price of $2.40. Now, that $2.40 really actually also includes a 30-cent premium that the project pays to us. This is not a freebie. There's not enough market data to have calculated that, but the 30 cents was what they knew they would have to pay us for the right to get this option. So the net price really for the carbon credit for the CER, the certified emission reduction in this case that they are getting, is really $2.10. which, if you think about where the markets are, is higher than what the market is, but there's a reason nobody's being able to operate these projects at current market prices because they're too low. But $2.10 also gives us an indication of the potential for what is out there. Yesterday at the same session the session ahead of me indicated that 850 million tons gets generated from methane every year. And we ended up servicing what was nearly 9 million tons. So there's a huge amount of potential out there. 12 winners across the globe. There were 28 bidders from 17 countries. We got 12 winners. Now to the main thing. What we are launching today is a report that is available on the stands at the back. It's our lessons learned report. Now that's really what we wanted to do with this pilot auction. Not only demonstrate that this works, but to be able to share the lessons from it and so that it could be replicated by other multilaterals, bilaterals, countries, whoever is interested in doing this, whether in the methane sector, other CO2 sectors, and we'll talk a little bit more about where we are extending it. So I won't go through each one of them, but bottom line is this report contains over 40 lessons learned and has recommendations on how to approach things based on our own learning. And they are categorized in 5 major subheadings, if you will. Pay attention to the auction design. It matters what your objective is, what the size is, and what the kind of thing. You cannot mix and match. If we had done, and I'll just give you a quick example, you can't mix waste with pipeline leakage from oil, from gas pipelines, for example, for the simple reason they have completely different economics, and you're going to end up with one sector or the other dominating it. So you have to, and geographically, you've got to, project eligibility is key. You've got to end up knowing what it is that you're doing, and you want to actually leverage the existing infrastructure that exists. And in this case, we use the CDM's infrastructure, not because CDM was an active offset market, but it is a very robust basis for results-based finance, which is what this project really, this initiative is about. It's a pay for performance. Marketing outreach is critical. We had webinars, in-person consultations, and across the world. All of that is listed in this report. Risk management is critical, whether it is on the process, on the auction, planning for it, but also in terms of ensuring that you get positive outcomes in delivery. IDD is critical, I mean, integrity, due diligence of the bidders, because at the end of the day, you are sort of having a relationship with them, even though it's somewhat different than an ongoing project finance type relationship. And finally, the delivery mechanism. And I already explained that we went to a simple bond approach, which was more easy to implement than a more complicated thing. I'm also happy to sort of, and I'm going to close up soon, Rick, before you get too anxious. I'm going to announce that we are ready for the second auction. I can't tell you the exact date, but we are hoping it'll be in the second quarter of next year. It'll continue to target meth. So we had an option of either shifting sectors or shifting the type of auction or doing whatever. So we're going to stay with methane in the wastewater, and agriculture waste sectors, exactly the same sector that we had last time, but we're going to flip the auction. Instead of doing a reverse auction, we're going to do a forward auction to test how that mechanism works. So we're going to set the price of the credit you will get paid, and I cannot tell you what that price is. That also will be announced soon, but let's just say, based on this whole experience, we offer $3 a ton. This time, the auction will go upwards, bidding the premium that the projects are willing to pay for whether it's $3 or $4 or $5, whatever is offered. Economics says that we should be able to pre-calculate that, but the auction experts tell us that will never happen, and it'll be a different dynamic that's worth exploring. That's pretty much it. It'll be very similar to like the first auction through to 2020, a 5-year option. And to close out, I just wanted to simply repeat what I said in the beginning. This is a tremendous, we believe now that we have demonstrated it, it is very replicable. It doesn't have to be limited just to some of the key sectors. We've already done a study outside of sort of based on this for the oil and gas and sector in terms of trying to address that. And we find that small, medium-scale projects in gas flaring, as well as projects involving leak detection, are very amenable to it. We are not going to go there with the pilot auction facility itself, but as a financial mechanism and an allocation method, we think this has a lot of potential. It's not applicable to anything and everything, but there's wide scope, and we are happy to sort of discuss that either in the Q&A or follow up with whoever is interested in that. So thank you again for your attention.
Thank you, Vikram. From a little bit of a housekeeping point, we're going to save at least 15 minutes for questions at the very end. So I know that was a very interesting presentation. But if you can hold a few of our questions, we're going to move on to the next initiative we want to highlight and present. And here it's a bit of a double introduction. The initiative is the African Clean Energy Finance Initiative, which is a project preparation tool that State Department also funds, and that's operated by OPIC as well as the U.S. TDA. I'm going to introduce here John Morton, who is currently the Chief Operating Officer at OPIC. Not only does he currently sit in government, but also brings a wealth of private sector experience. And directly from the private sector, one of the participants in one of the early ACEF-funded projects is Nancy Fund, who's with DBL Partners out in San Francisco, which is one of the largest impact investors in the U.S. So take it away, John.
Thanks very much, Rick. Welcome, everyone. Thanks for spending a bit of your Saturday morning with us. I thought before I speak about the specific initiative that Rick just mentioned, the African Clean Energy Finance Initiative, I'd step back for a minute and kind of reflect on why this conversation is so important for all of us. And it harks back to something Rick said in his introductory remarks, which is that the carbon challenge that we are facing is one which requires private sector capital to flow in ways that are increments many times exponentially larger than we are seeing today. There is no amount of public capital that can solve the climate challenge. Therefore, our goal as catalysts in government or in quasi-governmental organizations is to use the smallest amount of public capital possible to catalyze the largest amount of private sector capital. I think we all need to understand that, believe it, and then dedicate our lives to doing everything we can to get private sector capital flowing. That is not an excuse. That is not saying there is not a role for public capital. This is not a U.S. government position. I'm speaking as someone who cares about the planet and needs to see private sector capital flowing quickly, which is why investors like Nancy's group are so important, because they are doing this already. So our mission in life at OPIC, just as the IFC's mission in life and the development finance institutions of the G20 have as their mission in life, is to do just that. It is to provide tools, resources, and constructs, platforms, to crowd private sector investment into key development areas. And climate finance is clearly one of those. So I sit in front of you as the #2 person at an organization that has, over the last 5 years, seen our renewable energy portfolio grow over tenfold. And the reason why we are so happy about that, from $100 million a year to over $1 billion a year of investments in each of the last 5 years, the reason that's such a good thing is because that means that there are private sector clients desiring our services. We're not an aid agency. We don't give money away. We respond to U.S. private sector clients who are saying, we want your services, we want your loans, your loan guarantees, your political risk insurance to support solar, wind, geothermal, biomass, hydro, what have you. And so we've got a really great story to tell about the rising demand for OPIC services over the last 5 years. So that's the first thing. The second thing is we need to do more. We need to figure out how to be more catalytic. How can we be more innovative with products and services? And I think the auction example that Vikram just gave is a perfect example of a development finance institution innovating on the margins to catalyze more private investment into climate finance. The example that I'm going to talk about for just a brief moment here is another such example. We, OPIC, went to the State Department about 5 years ago, 4 years ago, maybe even 3 years ago, I don't recall, and said, you folks have a lot of money that you spend every year. you spend it on grants. What if you were to reorient a small amount of that toward an investment thesis and partner with us? Because we at OPIC see dozens of deals every year that we can't finance because they lack a little bit of project preparation support. These are deals that look viable, but need $200,000, $300,000, $400,000 worth of project preparation support in order to qualify for an OPIC loan. That could be an environmental impact assessment. That could be legal fees related to negotiating a power purchase agreement with a government that's never done a power purchase agreement before. Think about large swaths of Africa where the regulatory environment is still very much nascent. And these types of capital are big deals for small-scale investors. And so we said, listen, let's test a thesis that says with $20 million worth of grant money from the State Department, aligned alongside OPIC and the Trade and Development Agency of the US government, we can support a swath of projects in renewable energy in sub-Saharan Africa, which today are not getting financed. Let's try it. What's the worst that happens? The State Department loses, in quote, the $20 million that it was going to grant. What's the best case scenario? We leverage $1 billion worth of private capital. 2 years later, 2.5 years later, I can tell you, sitting here today, that we have made we have supported 30 projects. Those projects are well on their way to catalyzing over $1 billion worth of OPIC and private sector capital. We have financed 4 of them currently in our portfolio, and we have another 7 that are currently being underwritten for OPIC finance. And we expect that another 10 to 12 of the remainder will come through our pipeline next year. So, and they range from, large, when I say large in the context of this program is 30 megawatts, down to 1, 2 megawatt off-grid projects. And importantly, about 1/3 of the projects that we've supported are off-grid projects. These are projects that are either solar home lighting projects, mini-grid, microgrid, et cetera. So we believe that this partnership has proven 2 things. One, that you can reorient grant capital toward an investment thesis and done correctly, really catalyze a bunch of not only development finance institution funding, but also private sector funding. And secondly, that that facilities like this prime the pump for similar project development interest, because for the second round of the ACEF program, we have a stack of applicants on our desk, 10 times higher than what we had in the first round. So I would just applaud the State Department for being liberal with their pocketbooks, for trusting in this model. And I think this model is one that can be applied not only in clean energy, but it can be applied toward agriculture, toward water, toward, frankly, any sector where there's a bit of an alignment of concessional and government finance that will crowd in the private sector. And I guess I'd stop there because Nancy, as a pure private sector investor, I'm sure will have something to say about an investment in one of the companies that we've looked at as well, Off-Grid Electric.
Thank you very much, and thanks to Ashley and Rick for inviting me. Is it okay if I stand up? Thanks. So I'm Nancy Fund, the founder and managing partner of DBL Partners in San Francisco, which is the U.S.'s largest impact venture capital firm. And the DBL stands for double bottom line. We invest for a first bottom line, which everyone else does, to return on investment. For our limited partners, but we have a second bottom line, which is to drive social, economic, and environmental improvement in the regions and the sectors in which we invest. And we've been doing this for 12 years. We started as part of JP Morgan, but we spun out and created our own firm in 2008. And the good news is that we now have a track record, we have a body of work, and we're not at all a concessionary firm. We're a traditional venture capital approach, and in fact, we believe there's no sacrifice between driving for top-tier financial returns and driving for significant social impact. And we are able to tell stories now of how we have come to believe that there is the ability to have a no-sacrifice approach through investments in companies like Tesla Motors, the electric vehicle company, Solar City, which is the largest rooftop solar company in the States, a company called Nextracker, which we just sold to a big contract manufacturer called Flextronics. In 2 years, the company went from zero to being sold for $330 million. So these are stunning returns, these kinds of companies, and they're creating our future. They're creating a clean energy economy, very high quality jobs, and addressing the critical issue of climate change, which is why we're all here in Paris. So you're probably wondering, well, what the heck is she doing here? I mean, this is about Africa, this is about developing nations, and she's pretty much lodged in Silicon Valley. So the really exciting news is that because of the success that the industry is having in driving down costs, in developing business models that do bring a clean energy lifestyle to the average consumer in the developed world, we are now able to take this approach and adjust it and make it relevant and real to folks in the developing world. And so for the first time, in our 12 years of investing, we've never done an international investment. But we did one a few months ago called Off-Grid Electric. It's in Tanzania, and it is a massively scalable platform. It brings small solar panels and small ion lithium batteries to houses in Tanzania and now Rwanda, where we're expanding at the moment, and we'll expand further over the next few years. But anyway, it's rooftop solar, solar and storage that replaces the need for people in these areas to pay for kerosene lamps or have candles or whatever inferior lighting they have. And also, they don't have to walk several miles to charge their cell phones. They can do everything in their home and study, have parties, work at night, just really the opportunity to live a modern lifestyle. And that is really, for us as impact investors, incredibly important, but not just on the climate side, which is driving a big part of our investment, but on the economic development side as well. There's just no justification for a continent to have only a 4% of the population be in the middle class. That's just not okay anymore. And energy, cheap, available, clean energy is a ticket to the middle class for vast regions of the world that are wanting to join in a modern lifestyle. And so the reason that we invested now in Africa is because we see the opportunity to bring the benefits of the entrepreneurial economy. The entrepreneurial economy is what brings us all the things we can't live without. Our phones, our internet, our Twitter. I mean, this is what is making our life better and bringing people together across the world. Well, now it's time for energy to enter that entrepreneurial economy and to make the lives of folks, the 1.3 billion people in this world that don't have access to reliable electricity, to make that happen. Because that starts a path where everyone is able to earn more, develop better standards of living, and contribute to a growing, as I say, middle class. And so Off-Grid Electric already has 800 employees in Tanzania. It has about 20 in the U.S. And they've, because there was no infrastructure to really train people on how to sell and how to install these solar panels and storage units, they did that themselves. They created an academy. And so and now that academy is one of the best, most sought after jobs, the starting point with the academy and then getting a position in the company. The company is already ranked one of the best places to work in Tanzania, and it's really stunning to see that we have so many more applicants than we can take right now, but that will, so we're able to be selective, but still 800 employees over just a few years' work is a pretty significant growth rate. And so that is something that we invested in to to grow even faster and to provide more access to quality jobs to help transform the economies in sub-Saharan Africa. Now, on the climate side, we're able to, in some ways, very analogous to what happened with the telephones. Africa, in many ways, skipped the landline generation that we all grew up with and went straight to cellular because of the technology cost curve making that available. Well, that may well happen in Africa regarding energy, because right now there's no need to create expensive grids pervasively. There is a role for centralized power, of course, but there's a huge role for distributed clean energy where you have a choice of how much you buy and how much you use, and it's all cost accessible. And so through the advances in PV technology, battery technology, lighting technology, these folks are getting the most modern equipment to change from the past to the future. And so that will allow for an upgrade path in terms of making a business model that is scalable, will not only reach more people, but will be able to sell more products and services once we get people turned on to an existence with in-home electricity. So from putting a return on investment hat on, we see this as huge potential that we'll be able to create a company that will be iconic in the region and transform us from a 20th century lifestyle to one that is 21st century and beyond. So we're extremely excited about this. We have to win because we want more people to come into these regions and invest as we are, and that is happening. And we're very grateful to be here and to talk with folks on the panel and others, because we need to work together. We really do need to, we have debt needs, we have R&D needs, we really do have capital appetite that goes beyond pure risk equity to include development banks and various other approaches like OPIC and World Bank and such. So it's great to be here, and we're looking forward to collaborating as we change the world and develop a new future for sub-Saharan Africa. Thank you very much.
Thank you. Thank you, Nancy, and thank you, John, as well. I think we'll be opening up for questions now, but I may take a moderator's prerogative to kick off one question that's been on my mind, and this one I'll address to Vikram. Although it was sparked by something John said when he was describing the history of how the ACEF project came to be and how they brought this idea to the State Department and trying to think about there's got to be a better way to use some of this funding. And that's right. I mean, grant funding has its role and has its place, but there is a fundamental problem with it, which is it's based on a model where you provide me X, and then after it's provided, I will deliver Y. So all the operational risk ends up flowing to the provider of the X, and that's a misalignment of risk. What I thought the pilot auction facility does that's incredibly intriguing is why we immediately backed the idea was it flips that a little bit. And it really tries to test the opposite, which is if we provide you a outcome in the future, we can guarantee that liquidity. But in turn, you have to put skin in the game as the operator, and you have to take the operational risk as an operator. That's going to provide for better results, a more efficient use of capital, and greater impact. That's the idea. And we do this not because PAF by itself is going to solve the world's problems, but that PAF has the potential to demonstrate the effectiveness of this and be a replicable model. So that's a long-winded way of asking about a short question, which is, can this be a replicable model? How would you go about replicating it? Is there interest among other multilaterals, maybe the Green Climate Fund? Just curious where that sits now.
Yeah, thanks. Yes, I think, as I mentioned, we already did a study for the oil and gas sector. There are a couple other countries who are interested in sort of potentially looking at this as a framework for their own domestic market, especially some of the large countries that were not necessarily eligible in the screening and the criteria that we had for the first or the second round. Some may also want to use a different framework, not necessarily the CDM. The second auction I forgot to mention is going to use gold standard and VCS as well. So we want to experiment with that to expand the replicability. So, you know, at the end of the day, yeah, I mean, you can see that being used by corporates. But where the most interesting replication could come is, and we hope to inform this debate, if you take something like the GCF, for example, right? You're talking about providing this incentive, but it flips the incentive in the way it's a pay for performance. But what if the market developed sufficiently that it paid for the performance we never had to? So just extending the description I was giving earlier, if you had a long-dated option, which was deferred. So let's just say that we have a successful agreement in Paris, everything kicks in, by 2020 there is a reasonably vibrant carbon market again. But what if in the next few years you issued a 10-year option that was backdated from 2021 to 2025, underwritten by the GCF? You may never actually ever have to pay it. You have actually got a lot of climate finance leveraged. You have action in the market. And with, of course, the GCF would be on the hook to pay if there was no market. But in a way, that's a reverse of a moral hazard. It's better if we got a market going so that the limited climate finance never really actually got deployed directly and paid out. So I think the potential is huge. I wouldn't say I'd have to, I mean, I'm getting excited by what John said, but like what he said, this is not going to be the answer for everything. But I think the various leveraging mechanisms and the various sectors, replication potential is huge.
Thank you. And then I also had, not to dominate this, and we'll open it, I did have also a question on ACEF, and maybe it comes a little bit out of my personal experience, but prior to government, I was involved in private equity investment around renewables and often in developing countries. And the hardest challenge we had was actually pipeline, was seeking quality pipeline, because you found a small set of projects that really were at that kind of bankable or investable level, but then everybody was chasing those same few, and there was kind of a lack of pipeline. And what ACEF is able to do, at least in my mind, is really address that risk or that early stage development need, which is high risk money, and potentially low returns relative to the risk, at least for a lot of investors in coming in. And by using that ACEF money to do that early work to get it to the point where other investors can be interested in is very key. But I'm also curious, are you now finding other obstacles? So what are some of the other financial barriers that are still out there? I'm assuming this is not a panacea for renewable energy in developing countries. And this is really a question, for both of you.
Yeah, and I'll be quick because I know there's some questions in the audience. So I want to affirm what you said, Rick, a moment ago about the market catalytic impact of facilities like this. Deal flow is a huge problem, right? There's more money than there are deals at the moment in renewable energy, climate finance, in emerging markets where most of us work. So the question is, how do you catalyze more deals? Part of that is being more explicit about your interests as a development finance institution and saying, yes, we want to support renewable energy deals. That's just a marketing and branding exercise. Part of that is putting structures in place that show the market that you're serious about that. That's an auction mechanism. That's an ACEF program. That is actually showing to developers that there is true intent and true dollars available. And I think that we're doing both of those, and we've seen a rising demand for ACEF 2.0 as a result, I think, of the good hard work we did on the first part. To answer your question,
and an expansion to Central America and Caribbean.
And we're rolling out with the State Department support a similar facility for Central America and the Caribbean. Absolutely. So I think in response to your second question, what are other barriers? The list of barriers of investing into renewable energy in emerging markets are very long. Books have been written on them. We were talking before the session, probably one of the biggest ones is currency risk. All right, currency risk. What happens? You're lending into Rwanda, you're lending into Tanzania, you're lending into South Africa. Lenders like us want to have dollar-backed or euro-backed loans. However, the local currency markets are what they are, and there's a lot of uncertainty there. So there have been some very innovative solutions that are now reaching a stage where I think they will be impactful. Solutions like insurers like TCX, keep your eyes on them, who are now able to help hedge risks, again with a little bit of concessional finance for some of these hardest markets. So another example of using concessional grant monies to catalyze private sector capital to address a key barrier in renewable energy investing in emerging markets, in this case, currency risk. So TCX is a company to keep your eyes on.
I'm very heartened to hear of all of these new approaches. I would say from my perspective, it's actually the opposite. I mean, I could raise 4 more funds for all the deal flow that we're seeing now, just because we made one investment. I mean, we're deluged by interest from companies all over the world that would like us to help them. And we're small. Unfortunately, we can't help everyone, but you need a risk appetite. You need the role of early stage. You know, we may lose our investment. I don't think that will be the case, but we jump in and we know there are all these risks, but you know, we've proven that we can do this in other places, and I don't mean we, DBL, I mean the sector. Venture capital is all about going in when no one else will. And the good news is that once you have a win, once you have a high-profile success exit, then everyone else will come in. And that's what it takes for economic and social change. So, and it's a well-proven model. And so I think it's the most important thing is that we all work together to make these early investments successful, because then there'll be no stopping it. People will be in all over the world wanting to replicate the success of the early adopters.
Great.
Thank
Okay.
you. Any questions from the audience?
Yeah, why don't we go ahead and take 2 at a time? Is that okay? So 1 here and 1 there.
Hello, many thanks for the very interesting presentations. My name is Daniela Rafa, Renewable Energy Specialist with Golder Associates, working in Lima, Peru. Peru is a very interesting country. It's considered the 3rd most vulnerable country in the world to climate change. We're at a very interesting turning point right now. They've gone from 0 to 50% natural gas utilization in the electricity market within 10 years. And basically we're looking at over 100 gigawatts of renewable energy potential that's not being utilized. So we're trying to look for incentives for the government to maybe incentives in the form of financial incentives to make renewables a little more attractive, even though we're now looking at prices around $60 a megawatt hour for wind and solar, which is very interesting. But because of the natural gas subsidy, about 40% that's within the next 20 years going to be applied, it is still very difficult to be competitive. What opportunities are you seeing in terms of these types of financial incentives for renewable energy development in South America, in Peru, in the next 5 years, which might help at this very critical turning point in the country?
Let's do 1 more here.
I'm Tim Reutemann from the UNEP DTU partnership. I'm working in access to climate finance, and I have a sectoral focus on a sector that has a huge appetite for results-based finance, expressed, for example, in 49 registered programs of activities under the CDM. And a very concrete question to you, Vikram. Assuming I wrote you a concept note for the GCF for that sector, would you be willing to submit it?
So I'll address the first one in Peru. I was in Peru 3 weeks ago, visiting 4 solar investments that OPIC has supported down in the Tacna area, down in southern Peru. As you, I'm sure, know, December 18th is the date of bids for the next round of Peru's renewable energy program. You can't spend time. I lived in the Atacama Desert in Chile in 1991 for about 6 months. And I used to think then, this was 91, why the hell are there no solar panels here? This is the driest desert on the earth. The sun beats down on the damn place day after day, and yet there's no solar. So here we are, however many years later. And guess what? There's solar in the Atacama now. It's small. We helped get it going. IFC helped get it going. It's a great example of development finance institutions stepping in, catalyzing a market, and now the local financial markets are actually comfortable financing. So I'd say Chile, almost done from a development finance perspective. Peru's next. And what we've seen over the 3 rounds of bidding in renewable energy, as you know, is the price point has come down and down and down. The problem now is that they're facing the competition against unfair fossil fuel subsidies. I'm guessing, and I'm hoping 2 to 3 years from now, we'll be done. We'll be done in the sense that solar will have beaten natural gas in Peru. That's my personal desire, and I'm guessing that will happen. So hang in there, because the price point has come down so precipitously in solar in the last couple of years that I think there's only a matter of time before that country realizes where its real future lies.
Thanks, John. Could I ask a clarifying, what sector? We missed the sector you referred to.
I'm sorry, efficient cooking.
Efficient cooking. So look, on cooking, there is a lot of other initiatives going on right now. There's the Global Cook Stove Alliance and everything else, and we are quite engaged with that. And we are looking at a results-based finance facility for cook stoves as well. Now, whether that goes through an auction-based approach or not, whether that goes to the GCF, that's a separate dialogue, depends on their priorities as well. But it's certainly something we should look at together and make sure that whatever you're looking at is integrated into the broader discussion around cook stoves and financing that needs to have a global sort of and multi sort of prong push clearly. So yes, I mean, no, yes to cooperating, no promises on GCF.
Other questions? Okay, one here. Any others?
Hello, I'm Alistair Cameron from the New Zealand Treasury. Thanks also to the US for organising the event and to all the speakers today for your interesting talks. A question for Vikram. I mean, you said a couple of times that the PAF is useful in the right context. It's a tool that can be helpful in certain sectors. I'm just wondering if you could elaborate a little bit on what either the sectors are or the characteristics of the contexts in which the PAF could be useful.
That's it? Okay.
Yeah, any more? We do have one more. Great.
Thank you. My name is Shimon Mikawaiti from Climate Focus. Thanks a lot, first of all, for the very intriguing presentations. I also have a question for Vikram regarding the pilot auction facility. You mentioned in the first round there were 28 interested parties from the get-go. We know that there are several hundreds of so-called stranded methane projects in the steam pipeline. Do you foresee that in the next auction there will be a broader scope of participants? And if so, how will you incentivize more project developers to bid? Thank you.
Okay, yeah, great. On that, I think what I was trying to say was that the design, given that it's an auction-based design, you need a certain level of cohesion around a particular approach, if you will. So, the sector that you target should have, and if I can use the technical term, around some level of environmental integrity or an MRV approach that is robustly possible. So it's possible in a lot of sectors for the carbon market. So that's one. Two, you want to be careful about mixing and matching. The economics of the subsector or subsector must be aligned, otherwise you're going to get distorted results. The Total, you don't want oil and gas, I not mean to pick on Total, but if you can't have Total competing with the landfill operator in Peru or out of Lima or somewhere, not for any other reason, but because the economics of oil and gas are very different from waste. In fact, we considered at one time, and we may look at, even seeing whether LDCs, there needs to be a carve-out for LDCs, because the waste sector economics for LDCs are not necessarily the same as the waste sector economics in some of the other countries. So you can design auctions, because they might not, I don't think, any cleared at 240, to be quite honest with you, because the costs there are higher to operate. So those are the kind of parameters you're looking at. You can look at broader scopes. You want to look where there is, in terms of other sectors, there's nitrous and nitric acid production, for example. Then the other thing which is critical is you need to have enough, and this segues into the second question, you need to have enough bidders. You can't have 6 dominant companies or 4 or 5, 6 in a particular arena and then try and have a sufficiently competitive auction around that. So that's the kind of homework that needs to get done. In terms of incentivizing, I think outreach is the biggest thing that we did. you would think that there are many more projects. There was a lot of interest. The attendees across all our outreach on the web and in person was probably in the hundreds. But I think what you get out of this is distilling it down to those who are willing to put some, I think the phrase used was skin in the game, right? Even at 30 cents, that meant 30 cents per credit. If you were offering up at minimum of 10, I mean, in the end, the range was 100,000 to 2 million credits. That's not an insignificant amount of money. It's not huge, but it's not insignificant. So there is skin in the game. So you have to be able to do that. And so the incentive for companies to participate is that they'll get a substantially priced put option. But I think the disincentive, which in this case is not necessarily a bad filter, is that they need to pay up front. And the second auction will be even more interesting because if the price is higher than 240, so will the premium be. So let's see how high the premium goes. So that will also mean that their initial outlay by these companies could be higher.
Other questions? And I have one, actually, just to turn over to John and Nancy here. So Nancy, DBL Partners is an impact investor, and so you sort of, I'm a novice to the finance world, but you sort of balance a social good aspect with a financial return aspect. And I was just wondering, for the particular work in Tanzania, how do you work through that balance? And for your return on investment, how do you sort of compare that to what a non-impact investor would sort of look for? And then for John, just in the broad scope of who you're working with on ACEF, how does that balance? Is it mostly impact investors that you're working with, or is it a much broader range?
Thanks for the question. Obviously, we want to maximize financial return as we maximize impact. Because we go in so early, my belief is that impact investors get into areas of social change or climate earlier than traditional investors, and so that gives you more upside. Certainly when we invested in Tesla, I mean, everyone knows it's a huge success now, but it was almost a failure on a daily basis for many, many years. And so while we all look smart now, it was a very troubling, very stressful development for many years. And so that's kind of the world we live in. And so going into off-grid electric in Africa, we know all the risks, we know why we shouldn't do it, that we know all the naysayers out there that tell us we shouldn't. Well, if we had listened to them in Tesla, where would we be? Nowhere. And now we're in a position where we can use our legitimacy, our expertise, and say, look, guys, it's time. This is a great opportunity because it's early. There's a huge market. You have a differentiated technology approach, and you have a consumer population that is ready to buy. So that makes the risks worthwhile, and that's where you make exceptional returns. It's no different, really. It's just different kinds of risks. But each investment that we do has gone through a period where we thought we would lose all our money. So you just kind of have to have a thick skin and recognize you're in it, and the problems that we'll probably have, we don't even know yet. But that's what makes it a lot of fun, as well as incredibly meaningful, because again, it just takes those first few successes to change the paradigm, to get people to forget about all of the stuff that went before and say, this is what we want, and this is the train we're going to jump on.
Thanks, Ashley. And to your question, a project preparation facility supports a certain type of project. Large grid-connected, 100-megawatt projects that are hundreds of millions of dollars generally don't not go forward because they're missing $200,000 worth of cash to do an environmental impact assessment. The GEs of the world, the AESs of the world, they can finance big projects off their own balance sheet. They don't need an ACEF-like project. Where ACEF is useful is to address the smaller scale projects that, as we know, are going to be critical to providing first-time access, or at least more reliable access, to the 1.3 billion people around the world who either don't have access or the other 1.3 billion who have very unreliable access. So that takes you into companies like Off-Grid Electric, Novo Lumos, Power Hive, Simpa, Husk on the off-grid side. These are smaller developers doing, doing $5, $10, $20 million investments, to whom or for whom $200,000 or $300,000 is actually a big deal. They're not necessarily impact investors by core, although I think they tend to be more oriented in that direction. But they are smaller developers who do need a little bit of a boost in some of these more difficult markets.
Okay, I think we have time for one more, if there's one more question out there. And if not, I'll turn it over to the panel for closing thoughts. Okay, take it away.
Great. Thank you, everyone. This has been a very enjoyable session as well as very informative. And I hope everybody joins me in thanking our panelists. And I ask you to stick around 5 minutes or so in case people have some questions. Great. Thank you.